So I think for us, across the last few years, especially with the high interest rates environment, what we've been seeing or what we have actually encountered was obviously high interest rates. We have a lack of access to capital markets. So on our loan or our kind of debt profile, we've actually seen average tenors actually shortening. We've also seen in terms of the mix between loan and bonds, it's a large proportion of loans instead of bonds. So for example, right now we are about 90% loans versus where we would have been previously, which was probably like 60% loans versus bonds.
Because loans cheaper, or because you can get the shorter duration that you?
I think it's a mix. So loans was cheaper at that point in time because from a bond market perspective, I mean there was pretty much no investor appetite. So given there was no investor appetite, it's either I pay more or I just can't access. So from that perspective, average debt tenors were shorter. We do not have access to the bond market. So what we are seeing now, or rather, going forward, or what we're expecting, is that now the difference between an all-in cost of, let's say, loans versus bonds, the spread itself is compressing. So right now it's comparable. At the time, just last year or so, there was a lot of focus on bottom line, right? Given the high interest rates. So if, let's say, I had to do something a little cheaper, I had no choice but to do it. But right now, given that the spreads are actually compressing a little bit, we will take the chance to actually extend the tenor because, for the loan markets, the maximum that loan markets can actually give me is a maximum of 5 years. Whereas for the bond markets, it could stretch to like 7 to 10 years, as an example.